Hey everyone, welcome back to Corporate Decoder. Today, Intermediate Municipal Income ETF TAXE just filed a semi-annual shareholder report, and I'm seeing some interesting allocation trends. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a snapshot of where the ETF is putting its money and how it performed over the first half of 2026. So this is a report for the Intermediate Municipal Income ETF ticker. TAXE covers the period from the 1st of November 2025 to the 30th of April 2026. Basically, it is a look under the hood of this fund that invests in municipal bonds. Municipal bonds are issued by states, cities and other government entities and can offer tax-free income, which is a big draw for many investors. This ETF focuses on intermediate term bonds, meaning they typically mature in about 5 to 12 years. Let's start with the costs. For a hypothetical investment of $10,000, the cost over these 6 months was just $12. That is a really low cost, only 0.24% of the investment. This tells us that the management fees and other operational costs are quite efficient for this ETF, which is generally good news for investors because more of your returns stay in your pocket. Now, for some key statistics about the fund, as of the 30th of April 2026, the ETF had total net assets of nearly $157 million. That is a pretty good chunk of change. It held 498 different investments, which shows good diversification. The portfolio turnover rate was about 40%. This means that roughly 40% of the fund's holdings were bought or sold during this period. A moderate turnover rate like this can suggest a strategy that is not overly aggressive, but also not completely static. Okay, now for the really interesting part, where is this ETF investing its money? First, let's look at the geographic breakdown by state. New York is the largest allocation at 11.8%, followed by Texas at 10.1%, and then Puerto Rico at 5.5%. Other significant state allocations include Colorado, Virginia, Maryland, Arizona, California, and Alabama, each around 4 to 4.7%. The remaining 46.5% is spread across other states. This shows a focus on states with significant economic activity and a variety of municipal issuers. The inclusion of Puerto Rico is noteworthy as its bonds have historically carried different risk profiles compared to our states. Diving deeper into how the money is allocated by industry, we see that healthcare is the largest sector at 20.3%. Transportation comes in next at 19%, and housing is at 11.3%. General obligations from states make up 9.6%, and special tax bonds are at 9.2%. Education is another significant area at 7.9%. Other categories include electric at 4.1% and industrial and pollution control at 4%. The rest is in general obligations for local entities and other miscellaneous industries. This industry mix reflects the diverse needs of municipalities, from healthcare facilities and transportation infrastructure to housing and education. Let's look at the financial highlights for a share outstanding throughout each period. For the 6 months ended the 30th of April 2026, the net asset value per share started at $51 and ended at $50.97. In that period, net investment income per share was $0.96, but distributions were $0.93. The net realized and unrealized gain or loss was a small negative $0.06, meaning the value of the bonds dipped slightly. However, the total return based on NAV was 1.78% for that 6-month period. This shows a small positive return with income from the bonds being the main driver. Now we get into the nitty-gritty of the actual bonds held by the fund. This is a long list detailing individual municipal securities. For example, under Alabama, we see investments in Black Belt Energy Gas District bonds, with various coupon rates and maturity dates stretching out to 2051. There are also investments in Prattville Industrial Development Board bonds and Southeast Alabama Gas Supply District bonds. It is a detailed look at the specific debt instruments the ETF owns, showing the diverse issuers and structures within the municipal bond market. Scrolling through, we see holdings across many states and issuers. For instance, under Arizona, there are bonds from the Arizona IDA and Chandler IDA. California has a significant number of holdings, including bonds from the California Community Choice Finance Authority, California Municipal Finance Authority, and various airport and housing developments. This detailed listing helps understand the specific risks and diversification within the ETF's portfolio. Continuing to move through the portfolio, we see allocations in Colorado with general obligation bonds. And those from the Colorado day, we also see investments in Connecticut, Delaware, and the District of Columbia. The sheer volume of individual holdings highlighted here underscores the diversification strategy, spreading risk across a wide array of municipal issuers. Then we see Florida, Georgia, Hawaii, Idaho, Illinois, Indiana, Kansas, Kentucky, Louisiana, Maryland, Massachusetts, Michigan, Minnesota, Mississippi, Nebraska, Nevada, New Hampshire, and New Jersey. Each state section lists specific bonds with their par value, interest rate, and maturity. For example, in Maryland, there are bonds from Anne Arundel County and Baltimore, highlighting the focus on major metropolitan areas. The list continues through New Mexico, New York, North Carolina, Ohio, Oklahoma, Oregon, Pennsylvania, and then a very substantial position in Puerto Rico. The Puerto Rico holdings at 5.5% are quite significant. These include Commonwealth General Obligation bonds and sales tax financing bonds. As we saw in the state allocation, Puerto Rico represented a notable portion of the fund's investments, indicating a willingness to take on the specific risks associated with that territory's debt. Further on, we have South Carolina, South Dakota, Tennessee, Texas, Utah, Virginia, Washington, West Virginia, and Wisconsin. The Texas allocation is substantial at 10.1% of net assets, showing a strong presence in that state's municipal debt market. The number of different issuers and types of bonds within each state further emphasizes the broad diversification strategy employed by the fund. Looking at the statement of assets and liabilities as of the 30th of April 2026, the total assets were over $160 million. The investments themselves were valued at about $156 million with a cost of $154 million, meaning the investments have gained a bit in value. Liabilities were relatively small, around $4 million. Mostly due to custodian balances and payables. This leaves the net assets at $156.7 million with a net asset value per S-share of $50.97, which aligns with the financial highlights we saw earlier. The statement of operations for the 6 months ending the 30th of April 2026 shows a net investment income of over $2.2 million. This is the income generated from the interest payments on the municipal bonds. There was a net realized gain on securities of $158,000. But this was more than offset by a change in net unrealized gain or loss, which decreased by $525,000. This unrealized loss indicates that the market value of some of the fund's holdings decreased during the period. Overall, the increase in net assets from operations for this period was about $1.87 million. The statement of changes in net assets shows how the fund's net assets grew or shrank over time. For the 6 months ending the 30th of April 2026, the net assets increased by over $64 million. This growth was driven by the increase from operations of $1.87 million and significant capital share transactions, where shares were sold, adding $65.3 million. This shows substantial investor interest and inflows into the fund during this reporting period. The notes to financial statements provide crucial details about the fund's accounting policies and operations. It is important to note that this ETF, Intermediate Municipal Income ETF, uses GAA principles and is managed by Rowe Price Associates. The valuation of investments is done at fair value. And on the 30th of April 2026, all financial instruments were classified as level 2 in the fair value hierarchy, meaning their values are based on observable market inputs. This indicates a degree of transparency and reliability in how the fund's assets are valued. Finally, we have the section on the approval of the investment management agreement. This is where the board of directors reviews the performance and fees of the investment advisor, Rowe Price Associates. They concluded that the services provided were of good quality and the performance was satisfactory. The fees are based on an all-inclusive rate of 0.24% of net assets, which is considered competitive. The board found the fees reasonable, especially considering the fund's total expenses ranked in the first quintile, meaning they are among the lowest in their peer group. This suggests the fund is cost-effective for investors. Looking at this filing, the Intermediate Municipal Income ETF TAXE shows a diversified portfolio across many states and industries, with a strong focus on healthcare and transportation. The costs are very low, and investor inflows have been strong, indicating sustained interest. The slight unrealized loss in the period is common in bond markets, but is offset by the income generated. The significant allocation to Puerto Rico's debt is a point to watch, as it can carry higher risks. Overall, the fund appears to be operating efficiently and in line with its objective of providing tax-exempt income with moderate price fluctuation. The risk I am watching is how the fund navigates interest rate changes and the specific credit risks associated with its larger allocations like Puerto Rico. That is my take. Stay decoded. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Like, comment, subscribe, and join our Discord community.